Charlie Munger held only three major stock positions in his later years while building a $2.6 billion fortune. Today we're breaking down the exact mental models framework he used to pick those stocks, and why his systematic approach beat almost everyone who tried to outsmart the market. 2023 Daily Journal Corporation Annual Shareholder Meeting. Charlie Munger is 99 years old. Someone asks him how he picks stocks. Most fund managers would launch into complex valuation models, price-to-earnings ratios, discounted cash flow analysis, technical charts, momentum indicators, all the sophisticated tools that Wall Street uses to justify buying and selling thousands of stocks. Charlie looks at the person and says something that sounds almost too simple to be useful. We have three baskets for investing: yes, no, and too tough to understand. Three baskets, that's it. Decades of experience, $2.6 billion in net worth, partnerships with Warren Buffett on some of the most successful investments in history, and his entire stock selection framework boils down to three baskets. But here's what most people miss about that answer. Those three baskets aren't just categories. They're the output of a systematic mental models framework that Charlie spent 70 years refining. A framework so powerful that it let him hold just three major positions while most investors juggle dozens or hundreds of stocks, frantically trading in and out, chasing performance, and ultimately underperforming. Think about that for a second. Charlie's not diversified across 50 stocks. He's not rebalancing quarterly. He's not following hot trends or sector rotations. In his final years, he held Berkshire Hathaway stock, Costco wholesale stock, and Daily Journal Corporation stock. Three positions, decades of holding, billions in wealth. How did he know which stocks to put in that first basket? The yes basket, the basket that deserved his capital. Today, we're breaking down the actual framework, not theory, not generalities, the specific mental models and questions Charlie used to separate wonderful businesses from everything else. I'm Michael, and this is The Wisdom Investor, where we break down Charlie Munger's most powerful insights into investing and decision-making. So let's dive into this framework, because what I'm about to share with you is the result of going through decades of Charlie's shareholder meeting transcripts, reading poor Charlie's almanac multiple times, studying his investment partnership letters, and piecing together the actual systematic approach he used. And here's what's fascinating. Charlie's stock-picking framework isn't about finding the cheapest stocks. It's not about predicting the next hot sector. It's not even primarily about numbers. It's about asking the right questions in the right order to determine if a business belongs in that first basket. Let me start with the foundation, because this is where most investors get it wrong from the very beginning. Charlie's entire approach starts with something he calls circle of competence. And this is absolutely critical. Before he even looks at a stock, before he runs any numbers, before he thinks about valuation, he asks, do I understand this business? Not do I understand the stock, do I understand the business? There's a massive difference. Understanding the stock means you know the ticker symbol, you can read a price chart, maybe you've heard the company name. Understanding the business means you genuinely comprehend how the company makes money, what its competitive advantages are, why customers choose it over alternatives, how its economics work, what could disrupt it, and how management thinks about capital allocation. Charlie's threshold for this is extremely high. He said it explicitly in multiple shareholder meetings. We have three baskets, yes, no, and too tough to understand. That third basket, too tough to understand, is where most opportunities go, and that's by design. Think about what happened during the dot-com bubble in the late 1990s. Charlie and Warren at Berkshire Hathaway famously avoided tech stocks, not because they thought technology was unimportant, not because they were old-fashioned, but because most of those businesses fell into the too tough to understand basket. How do you value a company with no profits? How do you predict which internet business model will win? How do you analyze competitive advantages when the entire industry is being invented in real time? Charlie looked at those questions and said, I don't have the competence to answer them with confidence. Basket 3, moving on. And here's the key insight that most people miss. By putting something in basket 3, Charlie wasn't saying it's a bad investment. He was saying he didn't have an edge in evaluating it. And without an edge, without genuine understanding, you're just gambling. This is the opposite of how most investors operate. Most investors see a hot stock, hear a compelling story, maybe read some headlines, and think they understand enough to invest. Charlie's framework forces you to be honest about the boundaries of your knowledge. So that's step one. Before you even evaluate a business, you define your circle of competence. For Charlie, that circle included insurance businesses like Berkshire, retail businesses with strong brands like See's Candies and Costco, and companies with simple business models and durable competitive advantages. It did not include complex technology, biotech, or anything where predicting the future required expertise he didn't have. Now, once a business is inside your circle of competence, once you genuinely understand it, then you move to the next part of Charlie's framework. And this is where the mental models start layering on top of each other. The next question Charlie asks is, does this business have a durable competitive advantage? He's looking for what Warren Buffett calls an economic moat, something that protects the business from competition, something that lets the business earn above-average returns on invested capital for decades, not just years. And Charlie's very specific about what creates real moats. It's not just brand recognition. It's not just being the current market leader. Real moats come from specific structural advantages. Let me give you examples of what Charlie considers real moats. Network effects. A business gets more valuable as more people use it. Think about credit card networks. The more merchants accept a card, the more valuable it is to consumers. The more consumers have the card, the more merchants want to accept it. That's a real moat. It's very hard for a new competitor to break that cycle. Low-cost producer advantage. Some businesses have structural cost advantages that competitors can't replicate. Maybe they have better technology. Maybe they have scale advantages. Maybe they control a scarce resource. Costco is a great example. Their membership model and massive scale let them offer lower prices than competitors while still making good profits. Competitors can't easily replicate that model. Switching costs. Some products or services are painful to switch away from once you're using them. Think about enterprise software. Once a company has built its workflows around specific software, trained employees, integrated systems, the cost and disruption of switching is enormous. That creates a moat. Regulatory advantages. Sometimes regulation creates barriers to entry that protect existing businesses. Banking is an example. The regulatory requirements to start a new bank are substantial. That protects existing banks from competition. Charlie's looking for businesses where one or more of these moats exist and are likely to last for decades, not years, decades, because his time horizon for holding stocks is essentially forever. And here's where Charlie diverges from traditional value investing. Benjamin Graham, Warren's original mentor, focused on buying businesses trading below their liquidation value, cheap companies, fair businesses at wonderful prices. Charlie pushed Warren to evolve beyond that. He convinced Warren that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. What's the difference? A fair company at a wonderful price might be cheap today, but it has no moat. Competition will erode its profits over time. You might make money on the trade if you sell at the right time, but you can't hold it forever because the business economics are mediocre. A wonderful company at a fair price might not look statistically cheap today. You might even pay a premium. But if the business has real moats, if it can compound returns on capital at high rates for decades, then time works in your favor. You can hold it forever and watch the intrinsic value compound. See's Candies is the perfect example. 1972. Charlie and Warren bought See's for $25 million. By traditional Graham-style value investing standards, they overpaid. The tangible assets weren't worth $25 million. But Charlie had analyzed the business. See's had a brand moat. People in California associated See's with quality chocolate. They bought it for gifts, for holidays, for special occasions. See's had pricing power. They could raise prices every year and customers would keep buying because the brand created emotional value beyond just the product. That investment, the one where they overpaid by traditional standards, generated over $2 billion in profit over the next 50 years. Because the moat was real, the business could compound returns on capital at high rates indefinitely. That's what Charlie's looking for. Businesses where the competitive advantages are so strong that time becomes your friend, not your enemy. Now here's the next critical part of Charlie's framework. Once he's identified a business with real moats inside his circle of competence, the next question is, how good is the management and how are they incentivized? This is where that mental model we discussed in the previous episode, incentive-caused bias, becomes absolutely central to stock picking. Charlie has said explicitly, "Show me the incentive and I'll show you the outcome." He believes that how management gets paid will determine how they behave, and you need to analyze that before you invest. Here's what he's looking for. Are management incentives aligned with long-term shareholder value, or are they optimized for short-term stock price manipulation? Let me give you examples of good and bad incentive structures according to Charlie. Bad incentive structure: CEO gets paid with stock options that vest in 3 years with bonuses tied to quarterly earnings per share targets. What does that incentivize? Short-term thinking, accounting games to hit quarterly numbers, decisions that boost the stock price over the next few years even if they damage long-term fundamentals. Good incentive structure: CEO owns a significant personal stake in the business, receives modest salary, and has compensation tied to 10-year or longer performance metrics. What does that incentivize? Thinking like an owner, making decisions that build durable value, resisting short-term pressures. Charlie and Warren structured their own compensation at Berkshire to align with this philosophy. They pay themselves modest salaries. Their wealth is entirely tied to long-term Berkshire stock performance. They can't sell, they have to live with every decision for decades. That's alignment. When Charlie looks at a potential investment, he's analyzing management compensation structures. If he sees perverse incentives, he passes. Doesn't matter how good the business looks on paper. Bad incentives will eventually lead to bad outcomes. He's also looking at management's track record of capital allocation. Have they made smart decisions about reinvesting cash flow? Do they buy back stock only when it's undervalued, or do they waste money buying high to hit share count targets? Do they make acquisitions that create value, or do they empire build at shareholders' expense? Capital allocation skill is rare. Most CEOs are good at operations but terrible at capital allocation. Charlie's looking for the rare managers who excel at both. Now let's talk about the actual numbers Charlie looks at. Because once he's established that a business has real moats, good management with aligned incentives, and falls within his circle of competence, then he starts analyzing the economics. And here's what's interesting. Charlie doesn't obsess over complex valuation models. He focuses on one primary metric: return on invested capital, or ROIC. ROIC measures how efficiently a business converts capital into profits. It's calculated by dividing the operating profit by the total capital invested in the business. A business with high ROIC generates a lot of profit from relatively little capital investment. Why does Charlie care so much about ROIC? Because it tells you about the quality of the business economics and the durability of the competitive advantage. Think about it this way: a business with low ROIC needs to keep investing massive amounts of capital just to maintain its position. It's constantly having to spend to compete. That suggests weak moats. A business with high ROIC generates abundant cash flow from relatively little capital. It doesn't need to constantly reinvest just to stay competitive. That suggests strong moats. And that excess cash can be reinvested into growth, returned to shareholders, or used to make opportunistic acquisitions. Charlie's looking for businesses with ROIC consistently above 15 to 20%, sustained over many years. That's his signal that the competitive advantages are real and durable. And here's the magic of high ROIC businesses when you hold them long-term. Charlie has this famous quote: "Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns." If the business earns 6% on capital over 40 years and you hold it for that 40 years, you're not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive-looking price, you'll end up with one hell of a result. That's the core insight. Business quality measured by sustained high ROIC matters more than the price you pay, as long as you're not wildly overpaying. So Charlie's framework at this stage: inside circle of competence, real moats, good management with aligned incentives, high ROIC sustained over time. If a business checks all those boxes, it goes into the yes basket. Now let's talk about valuation, because Charlie does care about price. He's not going to pay any price, but his approach to valuation is different from most investors. Most investors use complex discounted cash flow models. They project future cash flows 10 years out, pick a discount rate, calculate a present value compared to the current stock price. It looks sophisticated. It's mostly nonsense, according to Charlie, because you're making guesses about unknowable future numbers and then pretending you have precision. Charlie's approach is simpler. He asks, is this business worth substantially more than I'm paying for it? Do I have a margin of safety? He's not trying to calculate exact intrinsic value to 2 decimal places. He's trying to establish that the business is clearly worth a lot more than the current price, even being conservative. Here's his mental process based on what he's described in meetings. If this business can earn 15% ROIC for the next 20 years and I pay 10 times earnings today, will I do well? If the answer is obviously yes, even with conservative assumptions, he buys. If the answer requires heroic growth assumptions or perfect execution, he passes. It's a margin of safety approach, not trying to be precisely right, trying to be approximately right with a cushion for error. And here's the other key part of Charlie's valuation philosophy. Once he's bought a wonderful business at a fair or good price, he doesn't constantly reassess whether it's overvalued or undervalued. He's not trading in and out based on valuation bands. He holds. This is critical. The yes basket is not a trading basket. It's an ownership basket. Charlie's philosophy is that if you've done the work to identify a truly wonderful business, one with real moats, great management, high ROIC, then you should sit on your ass and let compound interest work for you. He calls it sit on your ass investing. Find wonderful businesses, buy them at reasonable prices, then hold for decades while the business compounds intrinsic value. The tax efficiency alone is enormous. If you're trading in and out, you're paying capital gains taxes constantly, dramatically reducing your compound return. If you hold for decades, you defer all those taxes, letting the full pre-tax returns compound. And you avoid the biggest wealth destroyer in investing, selling wonderful businesses too early because they look temporarily overvalued, then watching them compound into much larger positions you can never buy back at a reasonable price. Charlie watched this happen to countless investors who sold Berkshire Hathaway at various points because it looked expensive. Every single time, those investors ended up worse off than if they'd just held. Now let me show you how this framework plays out with specific examples, because Charlie's actual stock picks demonstrate the system in action. Costco. Charlie joined Costco's board in 1997 and has held the stock for decades. Let's analyze it through his framework. Circle of competence. Charlie understands retail. He understands membership business models. It's a simple, understandable business. Durable competitive advantage. Costco has a structural cost advantage. Their membership model lets them make profit from membership fees so they can price merchandise at near cost. Competitors who don't have the membership model can't compete on price. That's a real moat. Management quality and incentives. Costco's management has historically prioritized long-term customer satisfaction over short-term profit maximization. They resist Wall Street pressure to raise prices faster. They pay employees well, reducing turnover and improving service. Management thinks like owners. Return on invested capital. Costco consistently generates strong returns on invested capital. They don't need huge capital investments to maintain their position. Each new store generates strong cash flow. Valuation. Charlie didn't buy Costco at the absolute bottom. He bought when the moat was clear, the business was proven, and the price was reasonable relative to the quality. Result: Costco stock has compounded at strong rates for decades. Charlie still holds it. It's one of his 3 major positions. Classic example of wonderful business, reasonable price, hold forever. Compare that to how most investors approach stock picking. They're looking at price momentum. They're trading in and out based on quarterly earnings reports. They're trying to predict next quarter's numbers. They own 30, 50, maybe 100 different stocks because they don't have confidence in any single analysis. Charlie's framework is the opposite: deep analysis on a small number of businesses, high conviction, long time horizons, sit on your ass. Let me give you one more example to crystallize this. Daily Journal Corporation. This is the company Charlie was chairman of. It's a small company, market cap under $1 billion. Why did Charlie keep his money there? Let's analyze through his framework. Circle of competence: he was literally running the company. Ultimate circle of competence. Competitive advantage: Daily Journal has a legal notice publication business in California with regulatory moats. They've been investing the cash flow from that business into technology software for courts. Decent moats in both businesses. Management: Charlie was the chairman. Management was him. Ultimate alignment. Return on capital: the core businesses generate cash without requiring significant reinvestment. Result: Charlie held Daily Journal stock until the end of his life. It was one of his 3 major positions, not because it was going to be the next Amazon, but because it was a good business. He understood it completely, and the capital was earning reasonable returns with minimal risk. Now let me connect this back to that 3 baskets framework we started with. By now you can see how businesses end up in each basket. Basket 3, too tough to understand. Most businesses go here. Charlie didn't understand biotechnology, so every biotech stock went into basket 3. He didn't understand cryptocurrency, so anything crypto-related went into basket 3. He didn't understand complex financial derivatives, so those went into basket 3. This basket is huge, and that's fine. Charlie's not trying to evaluate everything. He's trying to find a small number of businesses he can evaluate with confidence. Basket 2, no, these are businesses Charlie understands well enough to be confident they don't have durable competitive advantages. Maybe he understands the industry, but this particular company doesn't have real moats. Maybe the management has misaligned incentives. Maybe the business model is deteriorating. He understands it, but he knows he doesn't want to own it. Basket 1, yes, this is the smallest basket. Businesses Charlie understands deeply with durable competitive advantages, excellent management with aligned incentives, high ROIC, trading at reasonable prices. These businesses get capital. And here's the discipline that makes this work. Charlie's willing to hold cash if he can't find yes basket opportunities. He's not forcing capital into mediocre ideas just to be fully invested. If everything's in basket 2 or 3, he waits. This patience is critical. Most investors feel pressure to always be doing something, always be buying something, always be trading. Charlie's framework says, wait for the perfect pitch. Wait for a business that clearly belongs in basket 1, then swing hard. Let me give you some practical ways to apply this framework to your own investing. First, define your circle of competence. Write down the industries and business models you genuinely understand. Be honest. Most people's circle is smaller than they think. That's fine. It's better to know the boundaries clearly than to pretend you understand things you don't. Second, study businesses within your circle of competence. Not stocks, businesses. Read annual reports. Understand how they make money. Study their competitors. Think about what could disrupt them. Build genuine understanding. Third, for any business you're considering investing in, ask Charlie's questions in order. Do I understand this business? Does it have a durable competitive advantage? Is management good, and are they incentivized correctly? Does it generate high returns on invested capital consistently? Is the price reasonable relative to the quality? If the answer to any of those questions is no or unclear, that business doesn't belong in basket 1. Fourth, when you do find a yes basket business, buy it and hold it. Don't trade it. Don't try to time it. Just hold it and let the business compound value over years and decades. Fifth, be patient. You don't need dozens of ideas, you need a handful of wonderful businesses. Charlie held 3 major positions in his later years and built billions. You don't need more ideas than that, you need better ideas. Here's the thing that most people miss about Charlie's investing framework. It's not really about stock picking, it's about business evaluation and patience. Charlie succeeded because he could see which businesses had real competitive advantages that would last for decades. And then he had the discipline to hold those businesses through market volatility, through temporary setbacks, through periods when the stocks looked expensive, through everything. Most investors can't do that. They find a good business, buy the stock, watch it go up, sell because it looks expensive, watch it keep going up, feel regret, buy it back higher, watch it go down, panic, sell, and repeat this cycle until they've destroyed their returns through overtrading. Charlie's framework eliminates that. Find wonderful businesses, pay reasonable prices, hold forever, let compound interest work. That's the actual framework, not complex. Not about predicting the market, not about trading, just deep business analysis, mental models to evaluate quality and patience. Now I want to hear from you. When you look at your current investment portfolio through Charlie's 3-basket framework, how many of your holdings genuinely belong in basket 1? How many do you deeply understand with real competitive advantages, great management, and high returns on capital? Drop a comment below and let's discuss. If you found this valuable, hit that like button and share this episode with someone who's trying to build wealth through better investing decisions. It really helps us reach more people who can benefit from Charlie's framework. We release new Charlie Munger episodes every day on the Wisdom Investor, so subscribe and turn on notifications so you never miss an episode. I'm Michael, this is the Wisdom Investor, and I'll see you in the next one.